Um, Sorry about the late start to YouTube. We're just talking about the Moody's cut. Moody's cut the U.S. sovereign credit rating to AA1 from AAA late on Friday due to concerns about the $36 trillion debt. Worries about the ever-increasing U.S. deficit were front and center as Trump's sweeping tax cut bill won approval from a key congressional committee on Sunday. The overall mood across markets is not of panic, but of re-rating the same risks that started with the new Trump administration, Bob Savage, head of markets macro strategy at BNY. The equity market moves are likely to focus on leverage in companies and what the debt downgrade could mean to borrowers. 6 of 11 S&P subsectors fell, with consumer discretionary and energy being the worst performers. Most megacap and growth stocks recouped some of their losses around noon, though Tesla lagged with a 3% fall. Highly valued tech stocks were pressured as rising rates tend to discount the present value of future profit. Chip stocks also sold off, with a gauge for semiconductor stocks losing 1%. Still, stocks were off their lows, with the yields in US government bonds also easing from the highs. The S&P 500 had registered its fifth straight day gains on Friday, closing out the week with firm gains as markets took heart from a temporary tariff truce between US and China, along with the tame inflation data. Bessent said in television interviews over the weekend that Trump would impose tariffs at the rates he had threatened last month on trading partners that did not negotiate deals in good faith. The Fed might only be able to cut interest rates by a quarter point through the rest of the year, Atlanta Fed President Raphael Bostic said, while New York President John Will, that's not what he said. I watched the interview, that's not what he said. Um, he said he forecasted 1 quarter point cut, but the Fed dot plot shows 2. The New York Fed President John Williams said that the interest rate policy was well placed to deal with an uncertain economic outlook. TXNM Energy jumped 7% after utilities said it would be acquired by the infrastructure unit of Blackstone in a $11.5 billion deal. Declining issues outnumber advances by 2-to-1 ratio on the NYSE and a 1.9-to-1 ratio on the NASDAQ. Okay, let's look at what John Williams said. Fed Williams says he has not seen any big move out of U.S. assets, monetary policy in good place. New York Fed President John Williams acknowledged on Monday that investors are taking a look at how they invest in the U.S. assets, while noting he's seen no large-scale move away from the nation. That's not true. That's not true. China has been moving monies from treasuries to gold. But I guess he's referring to the last few weeks. Adding that U.S. central bank can take its time before deciding its next interest rate move. We have heard over the last few months there are some rumors or concerns about, well, do investors want to be so heavily invested in treasuries and other dollar assets given the big government policy changes and large levels of uncertainty, Williams told the Mortgage Bankers Association conference in New York. Makes sense of the amid this debate, we're not seeing major changes in how investors deploy their cash in U.S. markets. Although in the treasury bond market, we have seen some price effects, Williams said. There you go. In the treasury bond market, we have seen some price effects. So how does that? Okay, so they're not leaving the market entirely. Well, okay. Investors have viewed and continue to view the US as a great place to invest, including treasuries, fixed income assets. So I think the narrative is still there, Williams said. But he added that with all the volatility and uncertainty, investors are reflecting on how they want to invest their portfolios. Williams, who leads the Fed bank closest to markets, also said when it comes to core fixed income markets like the treasury market, the sector has been functioning very well. The New York Fed chief also said the economy is doing very well at the moment amid lots of uncertainty and some signs in recent data that there could be trouble ahead. Fed interest rate policy is slightly restrictive of the growth and is well positioned for what lies ahead, he said. It's going to take some time to get a clear view on how the economy is faring given all the government policy shifts and that we can take our time to figure out where interest rate policy stands. He said clarity on the impact of things like the surge in import tariffs implemented by the Trump administration will not come quickly. Yeah, it's going to take 3 to 6 months. Williams cautions against expecting imminent clarity on the economy and said some certainty is not going to be in June or July. Okay, interesting. So that's new information. Williams said some certainty is not going to be in June or July. Interesting. So Q3, Q4. Okay. Let's look at any sort of news, other news that we can maybe. Wall Street says buy the dip after Moody's credit downgrade. Something deeper is going on with the financial markets right now, says Citi CEO. Let's look at that. Besant send reciprocal tariffs threat to trade deal laggards. We just talked about that. Dell unveils new AI service powered by NVIDIA chips. Let's look at that. Chip ban deeply painful as $15 billion in sales have been lost, according to NVIDIA's CEO. Okay. Let's look at that. BBS CEO, new CEO quits amid potential Trump lawsuit settlement. Interesting. Interesting. Let's look at that. Tesla's down to start the week, and news out of China could be why. Okay, let's look at that. Regeneron buys 23andMe in bankruptcy action. Skip that one. Gold gains as dollar slides following Moody's US downgrade. Skip that one. Kering names Piccoli new creative director. Forget that one. All right, I think that's probably. Let's look at JP Morgan sees high grade debt demand up. Okay. XAI's Grok 3 comes to Microsoft Azure. Let's look into that one. Microsoft wants to tap AI to accelerate scientific discovery. Okay. All right. So let's go through those articles. It may be JP Morgan's Investor Day today, which brings with it the inevitable Jamie Dimon CEO successor chatter. But a hat tip to Citigroup CEO Jane Fraser for aiming to snag a few headlines of her own in a rare blog post on Friday. Interesting. Let's read that blog post. Should I read the article or the blog post? Let's read the article. They're about the same length. We are entering a new phase of globalization, one less defined by cooperation and more by strategic self interest, Fraser wrote. Long held assumptions are being challenged, not just by tariff announcements, but by a deeper confidence shock. The near term impact is already being felt, and the long term trajectory is being rewritten in real time. Fraser said the markets are signaling a shift by moving to price greater risks into assets. If you're looking to markets for clarity, you might be a tad disappointed, Fraser wrote. But if you're looking for signals, they're everywhere. Treasury yields rose even as equity markets wobbled. The US dollar, typically a safe haven, has weakened at moments when it used to rally. That tells us something deeper is going on, she continued. Investors aren't just pricing near term risks, they're reevaluating the credibility of long held certainties. It's showing up in how capital moves. Pensions and asset managers are tilting more toward Japan, India, and parts of Europe. Hedge funds are being selective and didn't chase the April equity bounce. Sovereign wealth funds are diversifying more aggressively. Hedging against the dollar is now at levels we haven't seen in years. Marcus just got a negative surprise in the US losing its sterling AAA credit rating. Moody's downgraded US government late Friday, blaming large fiscal deficits and rising interest costs. Stocks sold off across the board. Treasury yield rose about the key 4.5% level. Another market surprise lying in the weeds is the third quarter earnings season, which typically begins mid-October. Professionals think the cumulative effect of tariffs will be most severe in the third quarter, much to the dismay of upbeat analysts who continue to expect bumper corporate profits. I think there's a lag between the tariff announcements and when they actually hit the earnings. Research founder Adam Parker said on Yahoo Finance opening bid podcast. So I suspect it's more likely that third quarter numbers that are going to soften a little bit. Yeah, makes sense. Let me just read a couple more paragraphs from the actual blog post. Interested in what the CEO says because it actually goes contrary to what we heard from Bank of America CEO. So let's see. He says, let's be clear, the dollar isn't going anywhere as a global reserve currency. Oh, the article left it out. And the US retains enormous advantages, deep capital markets, a flexible labor market, and an unrivaled entrepreneurial spirit. What we're hearing on the ground, the economic consequences will play out more slowly. Tariffs work like sand in the gears of growth, increasing friction over time. We're hearing it directly from clients. Orders are stalling. Ports in Shanghai, Shenzhen, and LA are seeing sharp drops in volume. At the same time, there may be a break in the clouds. With inflation cooling slightly and a temporary agreement between Beijing and Washington to lower tariffs, markets rallied sharply this week, and investors now believe the worst case scenario is off the table. Still, uncertainty remains. Companies are pausing decisions, delaying capex, and holding off on hiring. Many are preparing for second and third order effects from demand shocks to supplier uncertainty. CEOs tell us they can absorb a 10% tariff, but 25% or more changes the calculus. Some pharma companies are shifting production to the US to avoid tariffs and use existing dual sourcing capabilities. Other parts manufacturers are also exploring relocation options, although facility buildouts require long lead times. Airlines are reworking schedules and accelerating aircraft purchases, particularly for US bound routes. And in Turkey, Morocco, and Egypt, companies are evaluating shifting capacity to lower tariff scalable markets. These moves are incremental for now. Even if tariffs ease, the disruptions to trust, supply lines, and planning cycles will take time to unwind. And the rest of the world isn't standing still. Countries are looking inward and sideways. What emerges could be a more multipolar system of trade and capital. That creates complexity and opportunity. All right, that's. Let's see what else is new. A couple of NVIDIA news. Let's go to NVIDIA, and then we're going to read about Tesla. Dell unveils new AI servers powered by NVIDIA chips to boost enterprise adoption. Dell Technologies on Monday unveiled new servers powered by NVIDIA's Blackwell Ultra chips, aiming to capitalize on the booming demand for AI systems. The servers, available in both air-cooled and liquid-cooled variations, sport up to 192 NVIDIA Blackwell Ultra chips, but can be customized to include as many as 256 chips. These servers can train AI models up to 4 times faster than previous models, Dell said. The pricing of these products will be competitive, Arthur Lewis, president of Dell's Infrastructure Solutions Group, told Reuters, adding that there is a lot of interest on what's next. Dell and Supermicro Computer have benefited from the growing demand for servers designed to handle the computer-heavy AI tasks, but the high cost of producing the systems and tough competition have pressured their margins. Dell in February forecast a decline in adjusted gross margin rate for fiscal 2026, while Supermicro projected fourth quarter revenue below estimates earlier this month as tariff-driven economic uncertainty pressures its performance. Dell will focus on increasing sales of networking and storage products to ensure the right level of profitability, Lewis said. The company's new service will also support NVIDIA's upcoming Vera central processing units, which will succeed the chip's designer's Grace server processor. AI server maker plans to support NVIDIA's Vera Rubin chips set to follow the Blackwell series. Dell also introduced a Pro Max Plus laptop designed for AI development on Monday, featuring a neural processing unit that allows engineers to process large AI models directly on the device without relying on cloud servers. Okay, great. And second and last NVIDIA news. NVIDIA CEO says chip ban deeply painful as $15 billion in sales have been lost as a result. NVIDIA CEO Jensen Huang at the Computex trade show in Taipei on Monday said the Trump administration's ban on its H20 chips for China has cost the company $15 billion in sales. During an interview with technology analyst Ben Thompson, Huang called the ban enormously costly and deeply painful. He pointed to the $5.5 billion in charges the company expects to see in its first fiscal quarter due to the ban. The company in history has ever written off that much inventory, he said. No company in history has ever written off that much inventory, he said. Not only am I losing $5.5 billion, we wrote off $500 billion, we walked away from $15 billion of sales and probably $3 billion worth of taxes. Wall Street analysts had projected that NVIDIA could see anywhere between a $10 billion and $16 billion hit to revenue over the coming quarters from the most recent export ban on its H20 chips. NVIDIA has repeatedly updated its chips for the Chinese market in the past several years to comply with ever tightening US trade restrictions, making the chip less and less powerful with each new iteration. The latest ban on exports and chips last month came just as the US government said it was investigating NVIDIA over the use of its AI chips in China. It cited the release of a cheap AI model from Chinese startup DeepSeek, powered by NVIDIA's prior generation H800s, which are currently banned from export to the country. Huang implied NVIDIA can't make another AI chip with its Hopper architecture for China under the current restrictions. That's the limit of what we can do to Hopper. And we've cut it down to there's not much left to cut, he said. Anybody who thought that one chess move to somehow ban China from H20s would somehow cut off their ability to do AI is deeply uninformed. He added that the China AI market is worth $50 billion a year. China is doing fantastic. 50% of the world's AI researchers are in Chinese, and you're not going to hold them back. You're not going to stop them from advancing AI, he told Thompson, who published the interview in his newsletter, Straight Cherry. Last week, the Financial Times and Reuters said NVIDIA is looking to open a research and development center in China, which a person familiar with the matter confirmed in an email to Yahoo Finance. Interesting. All right, Tesla. Tesla stock is down to start the week. A new Model Y arrival in China could be why. Tesla stock is down to start the week with news out of China perhaps weighing on the stock. Xiaomi said on its Weibo account that it will officially unveil its YU7 this week, a mid-sized crossover EV that will go head-to-head with Tesla's Model Y. The Chinese device and upstart EV maker said the YU7 will be revealed at Xiaomi's strategic new product launch event happening on Thursday, May 22. A render of the EV was shown late last year. Chinese EV blog CNEV Post was the first to spot the post. Xiaomi's SU7 EV sedan has been a huge hit with its domestic audience. The Porsche Taycan McLaren supercar-inspired design selling 135,000 units in 2024, with expectations for sales to more than double in 2025. And it's taking share from the Model 3, obviously. Xiaomi did not reveal any sales expectations for the YU7 or when expected in showrooms. I mean, it looks like Xiaomi is going to outsell Tesla China by 2027, which is amazing because they did this in just 2 years. The SU7, with its striking looks and tech-forward interior powered by a version of Android called HyperOS, was clearly been a hit with Chinese consumers who see their cars as extensions of their digital devices. Expectations are for the YU7 to follow a similar path to success. Tesla stock slipped in early trade down 3%. News of a rival competitor in one of Tesla's biggest markets certainly isn't helping the stock, though the tech sector in the US is also trading lower on economic and debt concerns. Tesla bulls are not complaining about recent performance, however. Tesla capped off another strong week last week, marking 4 straight weeks of gains and cutting its year-to-date losses to around 16%. Tesla's addition to Chipotle president Jack Wurtong to its board of directors helped boost the stock last week. Hartung said aid could aid the board in its quest to explore alternative ways to compensate CEO Elon Musk after a Delaware judge invalidated his $56 billion pay package. Musk's big bet on Tesla's future and its trillion-dollar market cap lies with the company's autonomous ambitions, with the company set to test unsupervised robotaxis in Austin this summer. Morgan Stanley analyst Adam Jonas said select clients met with Tesla's head of investor relations to talk about the state of autonomous driving last week. Key headlines from the meeting were that Tesla's Austin fleet size would be very low, think 10 to 20 cars, Jonas wrote, with plenty of teleops to ensure safety, meaning human intervention from remote locations when the robotaxi needed assistance. With companies like Alphabet's Waymo already performing 250,000 robotaxi rides per week in the US, Tesla's robotaxi offering is behind the ball. I agree. All right. One more article, and then we're going to call it a day. JP Morgan sees high grade debt demand up after US cut. High-grade corporate bonds are likely to grow more attractive to fund managers as bond yields are pushed higher following the U.S. losing its last top credit grading, according to J.P. Morgan Chase. Moody's Ratings lowered the credit score on the U.S. on Friday, joining Fitch Ratings and S&P Global Ratings in grading the world's biggest borrower below the top AAA position. Moody's cited concerns about ballooning debt and deficits that will damage America's standing as a global capital destination and increase borrowing costs. Perceived credit risk rose and stocks fell alongside long-dated treasuries on Monday, as investors feared the Moody's downgrade risks, reinforcing Wall Street's growing worries over the U.S. sovereign bond market as the ballooning budget deficit shows little signs of narrowing. Investors have been asking how such a downgrade could impact treasury valuations, both in the coming days and over the medium term. JP Morgan strategists, including Eric Bainstein and Nathaniel Rosenbaum, wrote in a note Monday, citing a separate note from their rates colleagues. In the near term, risks are skewed toward bearish steepening, when rates on the long-dated treasuries rise faster than the rates on the short-dated ones. Given trade and monetary policy's uncertainty amid a structural shift in demand, they wrote. Still, JP Morgan expects significantly smaller moves than the turmoil witnessed after early April tariff announcements, as the Moody's downgrade was widely expected. Investor positioning is also more neutral now, and will be less likely to exaggerate fundamental market moves than it did last month, they added. The downgrade comes at a time when investment grade market is in strong technical shape. Feinstein and Rosenbaum wrote, historically, when yields rise, there's usually less demand for retail investors, but more appetite from institutional buyers who own much larger share of the high-grade credit they added. If our rates colleagues are correct that the impact on yields is likely to be modestly higher rates, then we believe the near-term impact on spreads will not be significant and may be positive as long as equity markets are not too negatively impacted, JP Morgan credit strategist wrote. All right. On that note, thank you very much, everybody, and I'll chat with you all tomorrow. Take care.